Have you ever looked at your tax bill and just wondered how some people making millions of dollars can legally pay next to nothing? It's not some kind of magic trick, and it isn't about cheating the system. It's about knowing the rule book. In this breakdown, we are going to pull back the curtain on the core plays from the tax playbook that savvy investors and business owners use every single day. So let's kick things off by tackling a huge misconception about the whole system.
You know that feeling, right? You work hard, you have a good year, and then you get hit with a massive tax bill. It really feels like you're being punished for being successful. You might even hear some people say you should be happy to pay high taxes because it means you're making a lot of money. But is that really what's going on here?
The biggest mental shift you have to make is right here. According to expert analysis, the tax code is not a punishment. Think of it more like an instruction manual from the government. It's just a system of incentives designed to get you to do things they want you to do, like provide housing, create jobs, or invest in businesses. It's a game, and the key to winning is to play it the way it was designed to be played.
So what's the very first play? This one is the most fundamental, the most important concept in the entire playbook. You have to understand that the government does not treat all money the same way. Okay, check this out. On one side, you've got your earned income. This is the money you work for, your W-2 salary, your 1099 contracting gigs. This is the most heavily taxed income there is, with rates going all the way up to 37%. But on the other side, you have long-term capital gains. That's the profit you make from selling an asset like stocks or real estate that you've owned for over a year. And the top tax rate on that? Just 20%. I mean, that gap is massive, and it's the entire reason why the wealthy structure their finances the way they do. So here's the bottom line. The system is set up to heavily favor income you make from your capital over the income you make from your labor. So making sure a bigger and bigger chunk of your income comes from investments, well, that's the foundational strategy for crushing your overall tax rate. It is rule number one of the game.
All right, let's move on to the next play, because this is where it starts to get really interesting, especially with real estate. We're about to talk about how you can have a property that is literally putting cash in your pocket every month. But on paper, for tax purposes, it's actually losing money.
And the magic word that makes this all possible is depreciation. See, the government sees your rental property as a business asset, and it actually lets you deduct the cost of the building, not the land, just the structure, over a set period of time. This is what's called a non-cash expense. No money is actually leaving your bank account, but you still get to claim it as a loss on your tax return.
Let's make this super simple. Say you buy a rental property, and the building itself is worth $1 million. Well, the tax code says for residential property, you can write that off over 27.5 years. You do the math, and that creates an annual paper loss of over $36,000. You can use that loss to cancel out the actual rental income you're receiving.
And this is just wild when you really think about it. The government is literally giving you a huge tax break for the supposed wear and tear on a building that in most real estate markets is actually going up in value every year. It's one of the most powerful wealth building tools baked right into the system.
Now, getting that deduction over 27 and a half years is pretty great. But what if you didn't have to wait that long? What if you could pull a giant chunk of those deductions into the first few years? Well, you can. It's called a cost segregation study. Basically, you hire a team of engineers to go through your property and separate all the non-structural stuff. We're talking carpets, appliances, cabinets, light fixtures from the core building. All those smaller components can be depreciated way faster, over 5, 7, or 15 years. This lets you front-load your tax deductions and create a massive paper loss in the very first year you own the property. Okay, so now we know how to generate these huge paper losses. Now for the master stroke, the grand finale. How do we connect that loss to our main high-taxed job income? This is the play that can dramatically, and I mean dramatically, reduce the tax you pay on your salary or business income. But of course, there's a catch. The government put up a roadblock called the Passive Activity Loss Rules. For most people, losses from a rental property are considered passive, and that means you can generally only use them to cancel out other passive income, like profits from another rental. You can't just subtract it from your W-2 income.
So that's the million-dollar question, isn't it? How do you smash through that passive loss barrier and use these amazing real estate deductions to shelter your high-tax active income? Well, believe it or not, there's a very specific loophole written right into the code. The answer is the short-term rental strategy. Here's how it works. You invest in a property, think Airbnb or VRBO, where the average guest stays for 7 days or less. Then you have to materially participate in managing it, which has some specific rules about how many hours you put in. If you meet those conditions, the activity is no longer automatically considered passive. So you combine that with a cost segregation study, you create this enormous first-year paper loss, and then, bam, you can use it to directly offset your W-2 or 1099 income. For high earners, this can literally wipe out their tax bill.
So using these plays to build wealth is one part of the puzzle. But the playbook also has some incredibly powerful strategies for how to access that wealth and how to pass it on to the next generation in the most efficient way possible.
Okay, so let's say your stock portfolio or your real estate has ballooned in value. The amateur move is to sell it, but if you do that, you get hit with a huge capital gains tax bill. The pro move? You borrow against it. You go to a bank, you use your assets as collateral, and they give you a loan. And here's the kicker. Loan proceeds are not considered income, so you get to access all that cash completely tax-free. And all the while, your original assets are still in your name, still growing in value. Now for the final move. This is the one for generational wealth, and it's maybe the biggest one in the entire tax code. It's called the step up in basis. When you pass away and your kids or other heirs inherit an asset from you, its cost basis, what you paid for it tax-wise, gets stepped up to whatever its fair market value is on the day you die. The result of this is just staggering. It means all of the capital gains that built up over your entire lifetime are poof, they're just gone, completely forgiven by the tax code. Your heirs can then turn around and sell that asset the next day for its new, higher value, and they would pay zero, absolutely zero capital gains tax. It's a complete tax reset. All right, we have covered some seriously powerful strategies, but it is so critical to understand that none of this works if you don't have a rock-solid, compliant foundation. You can't just wing this stuff. Execution is absolutely everything. This means you need the right legal structures in place, like LLCs, to protect your assets and keep your finances clean. It also means you have to be meticulous. I mean obsessive about your bookkeeping. The IRS requires you to keep detailed receipts for any expense over $75. A line on your bank statement is not enough proof. These are the boring, non-negotiable fundamentals you have to get right to play the game legally and win. So you see, the tax code isn't just a set of rules designed to take your money. It's a roadmap. It's a series of incentives for building wealth. The strategies are all out there. They're written right into the law, just waiting for people to use them. So the real question is, now that you know the rules, how are you going to play the game?